Is Alan Brazil. I have a firm, SOM Macro Strategies, which stands for State of the Markets, which is a piece that I put out at Goldman for over 10 years, essentially looking at markets from the standpoint of finding asymmetric trading opportunities. The piece that I have today that I just sent out is looking at what I think is a pretty interesting asymmetric opportunity, which is betting against a recession. And betting against a recession because I think that the consumer is extraordinarily strong, will continue to spend. And as long as they continue to spend, it's difficult to envision a recession. So this piece is arguing that there are three pillars that support consumer spending. And you saw one of those pieces kind of play out today with the surge in retail sales. And I think that those kinds of factors will continue. I believe that there's three pillars that support U.S. Household consumption, and that is enough, I think, to offset any increase in recession risk. And there are three pillars. One is immigration, second is excess savings, and the final one is household wealth, particularly home equity wealth, all three of which would suggest that the U.S. consumer is much stronger than the market is anticipating. In the backdrop, I think what's unusual about the U.S. economy since 2020, there are two major factors. One is clearly the amount of money, the COVID spending that got pushed into the U.S. economy, which is as much as what happened during World War II, a massive amount of cash. And that's transformed the labor market and the U.S. economy. The second is more recently in the political issue of immigration surge, which has been substantial. And that is distorted many traditional measures of the labor market. And I think that, to me, that's something that even right now the market hasn't really come to grips with. One aspect is that it dampened a little of the wage increases that should have happened, particularly in the industries with low levels of human capital because of the surge of immigration. But there are two things that could happen going forward. One is the surge could stop, which means that the domestic labor has the ability to raise and ask for more wages. And the second is something that the CBO has identified, which is consumption. The amount of, given the magnitude of the people that have come in, it's an enormous tailwind to consumption and GDP growth. And I'll talk about that more clearly in the next 3 or 4 slides. Here are two indicators of the labor market that people point to as a precursor to a U.S. recession. The first on the left-hand side is the household survey numbers, which are used to calculate unemployment rate, which has basically shown that there's been little job growth in the U.S. economy in the last year. The one on the right is something that was talked about earlier, and now it's normalization. It's called a Beveridge curve, which is essentially looking at the job opening rate in the U.S. economy versus unemployment. And now that it appears to be back to normal, the next change in the labor market will be a higher level of unemployment. I believe both of these indicators are distorted by the growth or the surge in immigration. Here is the underlying economics of immigration, which is on the left-hand side, the amount of border encounters, which is given by the government every single month. And the numbers are in the neighborhood of 200,000 to 300,000 people a month are being processed through or going through the border. And this is just the people these are not illegal, these are people actually coming in and being processed. So the actual number is substantially higher. On the right-hand side is the CBO, the Congressional Budget Office estimate of the size of the number of people that are actually in this country, which is about 10 million people. How you see this is the difference between the two surveys. The household survey is the BLS surveys roughly about 60,000 households and asks them, are you working? The establishment surveys, they survey businesses and say, how many jobs, how many people have you hired? As you can see, there's a pretty substantial difference between the household survey and the establishment survey. And that difference is roughly about 5 million workers. Now, the problem with and I'll talk about it in a moment, is that the household survey is distorted because they're just not capturing the new jobs that have been created for new immigrants, legal or otherwise. While the establishment survey does capture that person, because they just ask an assessment how many jobs have been created. Now, if we look at the impact of the CBO versus what the BLS uses. For the household survey, BLS uses the census data, and the census data does not capture the recent surge in immigration. In contrast, the CBO does. So their estimate right now is that the difference in terms of population between what the census says is the population of the U.S. and what the CBO says is the population of the U.S. is roughly about 7 million people. On the right-hand side is the actual growth of immigration since 2020, and that number is roughly about 7 million. That is, the census has a population roughly 7 million less than the CBO, and which is reflected in the number of immigration. This is the estimates by the census, by the CBO, and by the Social Security Administration. You can see the CBO thinks, and what the CBO is trying to do is figure out how much money they're going to get from immigrants in terms of paying their bills. That is, they're looking at revenue from taxes and how much they have to spend on immigration. And that's why population projections are so important for the CBO. The census doesn't have such a mandate. So you see the green line versus the black line, that's the census versus the CBO. On the right-hand side, you can see over time the Social Security Administration has basically the same population estimate as the CBO. The census does not, as substantially lower. What will happen and what happens over time is that every year the census tries to go through and rebase their data and try to get closer to what the reality is of population. This is the trying to get at the Beveridge curve, why it's declined. On the left-hand side is the actual job opening rate, which is the dots, which is called the Beveridge curve. And the green line is the southwest border encounters for each month. What you've seen is that as there's a tightness in the U.S. market, which is reflected by higher levels of job opening rates, people from other countries come here, not surprisingly. And on the right-hand side, you see that adjustment when you look at the household survey versus the job opening survey. So the argument is this: the Beveridge curve does not reflect a weakening labor market. Rather, it's telling you that people are getting jobs. That is, the employment has grown, so they're filling those job openings, and that's why the rate is coming down. Not because businesses don't want more people to work, but those jobs are being filled. So that's one distortion that can be explained by the employment rate. One of the arguments for people coming to this country, obviously, is one of there's easier or harder to get into the country. What you see on the left-hand side is the actual number of immigrations versus labor market tightness. What you see is that across the different administrations, whether from Bush, Obama, Biden, and Trump, by and large, what you see is a systematic bias of as the labor market is tight in the U.S., people come to the U.S. for work. You see on the right-hand side is that factor in terms of Latin America, where a number of people are coming from through immigration. And what you see is that as their economies decline and our economy grows, there is more of an incentive to come to this country. Yes, there's plenty of other reasons why people come here, but certainly looking for job and income is a very prominent one, regardless of what the administration says. This is the argument for the CBO. The CBO argues that over time, the amount of those 10 million and growing in terms of the numbers of immigration is going to add a substantial amount of growth to the U.S. economy. So over the next 10 years, they argue roughly about $16 trillion of nominal GDP will be added to the economy based on immigration, which is a big number, obviously. On the right-hand side is the breakdown where that goes, what the consumption is, and clearly, not surprisingly, a significant amount of it is coming from is going into personal consumption. You also see the brown number on the bottom. That's residential investment. That is, if you're going to add 10, if not more, millions of people to the economy, you got to find a place for them to live. This is where they've come from thus far, based on the CBO. Surprisingly, at least in my mind, a good chunk of them are still coming from Mexico, but they're coming from across Latin America. And obviously, there's people coming from other parts of the world. On the right-hand side, you see kind of a smaller measure of economic growth in the U.S. or in Latin America and unemployment. And certainly when you had a shock in the system from 2020 from the COVID, their economies cratered. The U.S. did as well, but what happened in the U.S. is you had a massive amounts of cash coming into the economy and they recovered much faster. Now, Latin American countries have actually started to rebound, so there should be some slowdown in terms of immigration. This is an argument from the CBO where the immigrants are coming in. This is based on factor productivity or by and large job skills. What we've seen thus far is most of the people coming in are not nuclear scientists, but rather people with low human capital, low skill set. And you've seen that on the right-hand side, which is the impact. This is from the Kansas City Fed. It shows you the percentage point employment change through the immigration, as well as the impact on hourly wages. So even though there has been an overall growth in nominal wages, the industries that are most susceptible to hiring low-skilled workers have had much lower wage growth. This is just something for people to look at as a form of reference about what are the periods of time that you've had by administration major immigration reform. And what typically happens when you have immigration reform, before it actually gets implemented, the potential immigrants know it's going to happen and tend to surge ahead of it. It's happened every single time you've had a change in immigration. Probably the biggest was the Bush administration, Reagan administration, and the second was in post 2001 and closing the borders. And more recently, you've had this cycle of Trump and Biden, and certainly when Biden came in and by correlation, basically removed everything that Trump did, you've had a surge in immigration. Now, there's other factors that have led to that surge, not the least which was the economic growth in Latin America, but there's certainly some argument that it was a lot easier to come to this country with the lack of the Trump enforcement. This is the other thing that people haven't really focused on yet, which is I've argued quite consistently through time, is that the housing market is not a bubble. It reflects a underbuilding and a growth in people who want to find a place to live. That is household formation. So you've had a tightness in the housing market, which supports both housing prices as well as rents. And adding 10 million people to the demand for housing will exacerbate that and keep housing prices higher. So that's immigration. Immigration will support higher levels of consumption. And the second is excess savings, which is what I tend to look at is what people think about household behavior and consumption. And probably the one that gets talked about a lot is excess savings. In COVID, you've had a significant increase in cash that was given to them by the government. And the argument is how much of that is still around and people could use to consume. The argument is that by now, excess savings is down to zero, if not going negative, because savings rates are so low. So savings rates have to go up. That means people consume less, and that's a headwind to household consumption. That's wrong. But this is what they argue. If you look at the excess savings, which is the green is the savings rate, the red is the pay down or the use of excess savings to consume. And if you actually use historical growth rates of savings, which would put savings rate at close to 9% versus the 3% of today, there has to be a turn back of as excess savings goes to zero, people have to start saving and saving at a very high rate, which is a headwind to U.S. consumption. I think that's just wrong. What I argue is that the actual savings rate that you should be using to come up with that conclusion of how much excess savings is looking at a more consistent level of where should you be saving right now based on historical norms. You see on the right-hand side is that excess saving using trend, which is what a number of people use, and that has a negative amount of excess savings. What I use is the average of the last really 10 years. And so my excess savings rate is, of course, down, but it's now roughly about $1.5 trillion. And that's across the board. It's just not for the wealthy, it's for the lower incomes as well. Now, if you think the excess savings rate should be around what it is today, which is 3.5%, you can do that for an extended period of time. That is, you still have plenty of excess savings. And if you look at cash holdings of households, it certainly reflects the red line versus the black line, and but even conservatively, you have a lot of cash out there. The key to understanding savings rate is that it is a flow mechanism. And what people do is they look at why do I save? And the answer is, and lots of economic theory and practical implications would be that you have more wealth, you save less. You're saving because you want wealth in the future to do a lot of things. But what's happened since 2020 is household wealth has gone up substantially. And disposable income has gone up substantially. So if you have a lot of wealth growth, you need to save less. So there is a strong relationship between savings rates and wealth. And that, I argue, is the reason that savings rates are not going to go up. People can tap their household wealth to consume. They don't have to tap their disposable income. This is looking at it from the standpoint of household wealth, and particularly home equity wealth. You've had a growth since 2020 of roughly about $14 trillion of household wealth. Its net has been created. Now, if you look at that ratio of disposable income to home equities become a much bigger factor of how households look at the world. On the right-hand side, you see the savings rate plotted versus a kind of a moving average of that ratio of disposable income to household home equity wealth. That is, the more home equity wealth you have versus disposable income, the lower is your savings rate. And if you use that relationship, it says potentially, particularly if you can start tapping home equity, the savings rate could go down further. The next three slides are all about the argument that savings rates are down for everybody, but clearly the higher incomes are the ones that save mostly. So the argument is that the lower incomes are going to be stressed because their excess savings is negative. And my argument, that just misses who the low income people are. People look at the low quartiles or percentiles of household income. What they miss is that a significant number of those people are retirees. That is, the biggest source of income for them is Social Security. So that in of itself obviously has gone up a lot because of the inflation adjustment. But what you see is on the right-hand side, what also offsets that is that old people have all the wealth. So even though their incomes or wages, which is what is measured by personal income, isn't as high as others at the higher income levels, the actual wealth that they have is substantial. So if you look at wealth across the income deciles, what you see is that total wealth has grown across the deciles. And largely to a certain extent, if you're 70 years old, you have a house, and your income maybe has gone down, but your household home equity, as well as any equity that you might have in the stock market, has gone up as well. So my argument is that, yeah, I wouldn't worry about so much the impact of lower income by decile on consumption because they still have resources to consume. This is another broken down by income quartiles, what kind of home equity wealth that they've had, both on a nominal and real basis. I don't talk about it in this piece, but I do talk about it in other pieces. The single best asset a household can have is to buy a home and leverage it by 80% with a mortgage. If you look at that person in 2020 or 2021 who bought a house, their actual nominal returns, as well as leverage returns, I should say, both on a nominal and real basis, are close to 400%. It's an enormously effective asset because that 20% of home equity you have is now tripled in terms of value, as well as paying a 2.5% fixed rate mortgage is enormous value in terms of holding that wealth. This is the argument of how much current excess savings could ultimately mean in terms of extra consumption over the next few years. At its peak in 2022, excess savings by my measure, and a conservative measure, I would argue, was roughly $2.5 trillion. You spent versus that run rate, additional over the 1.5 years, almost 2 years now, roughly $1 trillion of excess consumption. You now have $1.6 trillion. And by that same rate of extra consumption, you have by and large over 3 years of potential additional consumption that you can afford through excess savings. Again, this is my vision of conservative view of excess savings. If if wealth continues to go up, home equity and the rest of the wealth components of households, you can sustain a higher level of consumption for a number of years. The third piece is talking about household wealth in general, which is higher household wealth means higher levels of consumption. And again, it's something that I've talked about for a while. This is a picture of a home that was bought in 2021. It tells you how much the home equity that you do have, the growth, and given where mortgage rates are, where is that what I would characterize as locked in home equity growth? That is given the inability to finance and sustain to take out that cash, to go from a 2.5% mortgage to a 7% mortgage and increase the mortgage by roughly 30%, it puts enormous strain on the household in terms of consumption or in terms of spending. So my argument is that there are a number of reasons why that locked-in home equity growth becomes consumption, not least of which is, I think, the new Freddie program, which is the argument of providing closed-end seconds to their borrowers that they have. And that rate could be substantially lower than the current coupon mortgage rate. This is the breakdown of home equity for both Fannie and Freddie, which are the potential sources of where the second liens could come from. The green is the amount of home equity for cash outs. That is, you're basically Fannie and Freddie owned or exposed to homeowners that have taken out a mortgage. And that number is roughly $2.6 trillion. On the right-hand side is a breakdown of what it would cost for them right now to go out and refinance and take out all the cash if they could. And the argument is that it's very difficult because you increase your monthly payments by a substantial amount. Although that's probably overstated because it is tax deductible. That is, if you're paying a 2.5% mortgage, you effectively pay roughly 2%. If you have a 7% mortgage, you pay roughly 4.5%. So there is a tax advantage to the higher coupons that are not taken into account. But it's very difficult to either take out the cash or what has happened historically is to go out and buy a bigger home, both of which I think are economically unaffordable for most people. Having said that, the amount of capacity for households to take out additional debt is substantial. That is, roughly speaking, the amount of mortgage payments that people were paying historically is almost twice the amount that they're paying today. On the right-hand side is the capacity versus historical of where they've been paying is closer to 17% of disposable income. Now it's substantially less. So there is the capacity, if they can get access to the credit, that they can add additional mortgages, whether it's home equity or cash out. So the households are fine. They're not stretched at all to make their mortgage payment, which is the largest part of their monthly payments. This is getting at where, and again, the Freddie program has been approved. They are starting a pilot program, and kind of getting at where I think that that mortgage should trade. And if the current coupon is the current kind of home HELOC loan market is in the neighborhood of, call it on average 9%, I think that people can borrow it through this program at roughly 6%. And so that's a substantial decline or savings versus going to the traditional bank market. So my argument is that you'll have a significant amount of take up of these home equities. And that will potentially release, again, up to $3 trillion of locked in home equity. This is looking at again, going back to that 2021 mortgage. What you see on the left-hand side is mortgage rates and the 10-year treasury rates. What you've seen is that while mortgage rates have gone up and are now starting to come down, as has the long end of the treasury curve, the spread between mortgage current coupon and treasuries is widened substantially. So you could have lower mortgage rates just by the mortgage market tightening 50 to 100 basis points, which would push the mortgage rate down to say 5.5%. On the right hand side, you see what I would do is a breakdown given a debt to or an income constraint, that is how much you pay every month for your mortgage. What it breaks down is where they stand. So, for example, right now, a home that they bought in 2021 has roughly called $120,000 of home equity. Given the funding constraint at 8%, at 7.5%, there is no possibility of getting a cash out mortgage. As you start moving down the mortgage stack to 7, 6.5, and 6, you see that the green is the amount of cash out you could take out by taking and still having an affordable mortgage. And certainly, if you get down to 3.5%, the amount of cash out is almost 100%. So again, what people miss in terms of the household wealth and ultimately consumption, if you do have a slowing economy, what happens is that the Fed cuts rates. The Fed cuts rates, the long end of the curve comes down. And what happens is that all of a sudden you unleash that $3 trillion of cash out for consumption. So it's a built-in buffer that will, I think, offset any weakening of the labor market. So this is just a sum up of the three pillars: immigration, excess savings, household wealth. All of these, I think, support higher levels of consumption and provide a significant barrier to slowing economic growth as well as levels of consumption. So the easiest way to play that trade, I think, and there are a couple of places a couple of trades I put on. So the next page is you just buy consumer discretionary versus the S&P. This is the performance of consumer discretionary versus S&P in 2023. Consumer discretionary is basically flat for the year. S&P is up quite a bit. In contrast, if you look at kind of ROEs, kind of consumer price to book, discretionary is very cheap versus S&P. And I think that the argument is that consumer discretionary is being hit by the view that we're going to go into recession. We're not going into recession. That sector starts to rebound. Another way to play it, which I haven't had in this piece, but I'll come out shortly with, is just playing the front end of the curve. Right now, you have 1 year. 1 year is in the neighborhood of 3.25. And even if you assume that the Fed's going to cut rates a significant amount, they're certainly not going to cut rates by almost 250 basis points unless we're in a recession. So one way to play the counter argument of a recession is to play roll up the curve. So that's kind of the conclusion, which I argue is that you have overall the consumer's a lot stronger than people think. Some of the indicators are distorted. Some of them don't account for household wealth, all of which can end up with significant tailwinds to consumption and ultimately economic growth. I'll also point you to I'm not sure if you've looked at it before. The Atlanta Fed has something called GDP Now. And by and large, that GDP number that they projected, which is real GDP growth quarter ahead, has been right on for probably 3 years. Right now, they're pointing to GDP growth in the third quarter of roughly 3%. What that means is that, and what they do is every single economic number that comes in, they adjust that number. And a consumer consumption continues, like retail sales, I'm sure it's higher today. Think about it. Do you really think that the Fed in the third quarter or the fourth quarter is going to aggressively cut rates if economic growth in the third quarter is close to 3%? The argument's no. So that's kind of a summation and how I look at the world. The establishments are still hiring people and hiring a lot of people. There's a point at which you can't hire anymore because there's not enough labor to hire. But I think that the establishment survey is what I look at. That's still creating a significant amount of jobs. And so, which means that the unemployment rate, which is based on the census data, the household survey, is just wrong. So in terms of loss of income, I think just the opposite. I think real incomes are going up and wages are going up on a real basis as inflation comes down. So I don't see on a real basis that you see any significant decline in income. Now, will people start to fire people? I mean, that could happen, certainly. But you're at such a level now, it's difficult to measure that. So when you see the word surges or shock, you're talking about a flatline data, and you have little wiggles in it, and that seems like it's big, but on a longer term perspective, it is not. So I haven't seen the income decline, and I think again that the household survey is just wrong. Now, there's certain firms that have tried to get at. I mean, I'm not the first one to identify there is an impact from immigration on those numbers, but it's very difficult. And when you go into the nitty gritty of how the Bureau, how the BLS calculates it, it is very, very difficult to replicate. They basically survey 60,000 people every month, and they ask them, "Do you have a job? Are you looking for work, or you don't lot working for work?" One of the factors that has led to looking at the employment survey is that the response rate has fallen dramatically. People are just not responding. So what happens is that the BLS starts to make numbers up, and that number doesn't. Those numbers, and they're still based on the census numbers, which says population, which is lower than CBO. So they don't know how to kind of deal with the lack of response. As well as, if you think about it, if job growth is happening in households that are here potentially illegally, how receptive are they to respond to the BLS in terms of the survey? So they could be missing a whole bunch of people who have jobs. And clearly, when they talk to establishments, there are being jobs and they are being created. It's amazing across the different asset managers that I talk to. Is one common theme is, what do you think in the video? It's like, you're a macro fund. What do you care about in the video? Oh, it's going up. So there's a lot of trend followers that are looking for things that are going to outperform. By the way, I have no view at all of the video, so I get that a lot. And the second is that the argument that the market's always right, and the market's telling you something, which is the economy is going to slow, and the Fed's going to aggressively cut rates, and that affects. Why do I think that that's wrong? And I'm saying, well, the market has been wrong consistently for the last 3 years. I mean, look at the curve. I mean, you've had shocks to the system of, oh my God, inflation's coming down, the Fed's going to cut rates, and you've had just the opposite. Oh no, inflation's higher, so the Fed's not going to cut rates. So you have massive moves in the rate complex, and ultimately the currency complex. When is the ECB going to cut rates, or is what's going to happen in China? So there are massive things that are going on in the backdrop. They're creating real-time distortions and behaviors as the market moves. And I think that in order to guide yourself through that, you have to understand what's going on. And I think you miss that. Do I think that the 1 year is going to be 3.25%, or it's going to be 3.25 in 1 year? The answer is no. So the question is, I look at that, and if you look at this deck that I just gave you, would suggest that the Fed's not going to be aggressive. And if the Fed's not aggressive, then where does that 1 year go? So do I think it could go lower? Yeah, sure it could. But you would need a recession to have the 1 year below 3%. There's people have rolled out, and there are certain ways to look at it in terms of where should the Fed rates be. There's something called the Taylor rule, which is looking at inflation and figuring out where the Fed should be in order to achieve that inflation target. And those numbers are Fed funds are neighborhood of 4.5% to 5%, which could be certainly lower than they are today. But if you believe, your target is 2%, and you have economic growth of 2%. And by the way, the Atlanta Fed has another tool that you can use that you can put in different scenarios for the Taylor rule. So when I look at versus the previous campaign in 2016, which is pretty easy to actually trade because there are very strong pillars or ways to trade a Trump victory. But this time around, I don't see it. I mean, I just whether it be Harris or Trump, it's difficult to find a strategy that's going to be so clear in either cases. So I think you rely on what the underlying economic scenario is going to be, rather than who's going to be president of the United States. I think, although I certainly there are people that are trying to come up with ideas around that, but I don't see it from what I look at. Something that's so clear in my mind. Play. One thing you can play, however, is that, and I talk about it in the previous piece, which is the equity markets are fine, believe it or not, if you incorporate uh, earnings growth. And traditional measures like PE or Shiller's PE don't really incorporate the significant increase in margins and profit margin earnings growth the last 10 years. If you incorporate that, the argument is okay, this market, the equity market is actually fairly priced, if not a little cheap. What can change that? And two things can change that. One is one of the reasons that earnings growth has gone up is because tax rates have come down. So if Harris wins, there's certainly a potential that the higher tax rates for corporations that was suggested by Biden and now by Harris could take a significant chunk out of margins and earnings of S&P. So that's one way of playing Harris. The other is that the share of labor of income from corporations has gone to labor has gone down. So even though wages have gone up, their share of earnings from corporations has actually gone down. And you think about it, it's not a surprise how many people work at Google or Microsoft, et cetera. So more of the money is going to the equity holders because of the nature of the underlying business model. So that could go away. So there's certainly arguments that, from a political standpoint, can affect both those channels of growth of earnings. But I don't really trade it one way or the other. But I'd rather spend more time on figuring out other factors. One of which is that how aggressively is ECB going to cut rates? I think if there's any central bank that's going to be more aggressively cutting rates, it'd be the ECB than the Fed. And then, of course, what's going to happen with China? Like, forget about whether they're going to invade Taiwan. Their economy is clearly slowing and slowing dramatically. What are they going to do about it? And the reasons why they're slowing down and what channels that they have. So there are two major decision process that I find more interesting than what happens to the U.S. election.